Welcome everybody. This is Adrian Zdunczyk, CryptoBurb, talking to you right off day 3 of our free trading congress. This is free virtual experience for traders to unite, to congregate as one big community to learn how to actually recover and buckle up around all of those recessive vibes, all of those bear market vibes that we've been seeing throughout entire 2022. Last year's edition in November 2021 was exactly happening a year ago. This time, the realm and the conditions are 180-degree different. And we're going to talk today to our great guests, to Mike McGlone and Doug Bompard, about the overalls of the risk in crypto. What are the risks? What are the risks measures? If you guys are ready to hear and get a lot of alpha, make sure you stay tuned. We're going there right in a second. Welcome again. Adrian Zdunczyk, again, free trading congress, free virtual experience for many traders to come and aggregate and unite. The best time is now is our motto, is our slogan, to learn, to come, to learn, to improve. The best investment you can ever make is investment in yourself. That's what Warren Buffett teaches. And today I'm joined by people who I truly have admired for many, many years. I'm talking about Mike McGlone, who I had the pleasure and honor to host some time ago on the show, senior macro strategist from Bloomberg Intelligence. And I'm also joined by Douglas Bompard, Doug, who is also president for Bonfide Wealth, CNBC Advisor Council, Outerod. So many good projects about the crypto drip, that I had is also the chance to talk and to learn about, and for Millennial Money Fix. How are you doing, gentlemen, today?
Good. Hello.
Doing great. We got Thanksgiving coming up.
Yeah, exactly, right? So kind of like, I think that Americans are right now heading into this proper long actual holiday, isn't it?
Yeah. Everyone's traveling right now. I feel, you can feel the volume of like tweets and energy is kind of subdued these last few days. I was watching my neighbor pack, luggage into their car. I couldn't believe like you're going to the airport the day before Thanksgiving. Sounds like an awful nightmare to me. But yeah, we're getting ready to have family come over. There's a lot of stuff on the kitchen table. We're cooking, we're preparing. I'm ready for a couple of days of just chilling with the family and basically eating and drinking.
There you go. How about
the American way?
How about yourself, Mike?
Well, I think Doug described it well. It's like he mentioned earlier in the back of my office. I'm in the DC office this week, and there's no one here. But it's one of the greatest holidays because there's no religion, no gifts. Just eat, be with family and friends, and watch some football and enjoy each other's company. So, yeah. I think it's the world's greatest holiday. Of course, I'm biased.
Perfect. I think that again, one of the already takeaways for the show you can actually grab is that Mike is there alone in his office. That's a true commitment. That's this huge dedication. I think that all of the markets.
Mike's escaping his family today.
Yeah. Well, there's some of us who have got this need. I got to get out. Working from home is great, but I got to get out and go places. As long as you got a cool place to go, and that's the cool thing. I'm not good about working for Bloomberg, but I wish that for everybody.
Perfect. Gentlemen, I'm so pleased to actually be joined here and honored to be talking to you today about the specific title, Crypto and Risk, Boom or Doom. This is the main narrative, right? We're going to talk about the risk side of crypto because we know that crypto is extremely volatile. It's an exceptionally volatile. However, stocks also are kind of like, chasing the back of crypto in terms of the volatility measures. But there are so many different, again, indicators. There are so many different reads and prints to assess and try to evaluate the crypto's volatility, the crypto's risks. So if you were to put it to kick off, the discussion in your own terms, like how risky is crypto? Doug, what do you think?
I mean, yeah, it's still going into the high risk profile here. A lot of speculation. In light of recent events, this I'm very pro. My early adoption is specifically with Bitcoin. If you're to ask me, and if there's anything that is good out of what's going on here, is it's really creating a separate. Jack Mallers said this on CNBC. He's like, people are really understanding now, hopefully, the difference between Bitcoin and crypto, right? And that's, I think, a very important thing. But the risk is super, super high, and not for the reasons you want it to be. You don't want the risk to be super high because, Sam Bankman committed, fraud. That's not where you want that risk to be, right? Like, that's the worst kind. You want that risk to be volatility. You want it to be price discovery. You want it to be, kind of more standard things that you've studied. If you're a CMT, if you're a CFA, if you're a financial professional, you want to look to those things. You don't want the fraud stuff. So that's now another layer, of unfortunate risk that's piled on top because trust has been eroded significantly in light of that. So anyone, you think about my clients who are mostly buy and hold passive investors for the long term, and the thing they need to do right is consistently invest their money, especially in down markets. This is obviously a much tougher terrain now to navigate. So it's still high up on that risk spectrum for most people. Let's not kid ourselves with the, I love to see more indoctrination. I love seeing that we've come this far with crypto and Bitcoin, but we have a ways to go, obviously, in light of what you're seeing. It's a big step back, unfortunately.
Very good touch there on the SBF, of course, side. I think we're going to touch upon that also throughout the show later. How about your Mike? Like, how risky is crypto within your perception?
Well, I think, Doug, I was hoping we can have a lot of disagreement. It looks like we're going to agree on a lot of stuff, which is going to be fun.
We'll disagree, I promise.
We got to find something that, to pound each other on. But that's the key thing I think he pointed out is that now we've added this layer of custody risk and exchange risk and things. And that's bit disconcerting, but these kind of things, as we know, in nascent technologies, work their ways out and most often become pretty significant buying opportunities. So the general way I typically view a risk in this space is what you mentioned before we got on, Adrian, is I look at usually annualized volatility of Bitcoin, a crypto index versus most other markets. And that's the key thing that struck me about a month ago is on a 30-day basis, on a 260-day basis, typically on an annualized basis, Bitcoin and cryptos reached the lowest measure ever versus in terms of Amazon, in terms of the Bloomberg Galaxy Crypto Index. And in the 30-day basis versus the NASDAQ index, our Bloomberg Galaxy Index reached the lowest ever versus the S&P 500. So that's typically a sign of, this space is getting mature. And now we had this shocker from FTX. And I view this as, so initially when the market broke down, that was my indications it's going to continue to break down because volatility is always a great indicator, particularly when you reach an all-time low. When markets break out from a consolidating range, with a good reason, it means it's going down a lot low. So that's why I put out initially that Bitcoin's more likely to it might not reach a plateau until the $10,000, $12,000 area. I'm still impressed. It's nice that Ethereum's holding $1,000, but volatility was a good indicator because it's always been, when it gets too low, it's the number one thing to remember volatility. It's always mean reverting. It always goes back up. Now, typically in the past, this has meant that cryptos were going to outperform indices, but it's an indication of what we need to put into context here is everything is going down this year. This has been the worst year ever for stocks and bonds combined. I mean, ever. And most, if you go back 80 years, and most of us aren't around that long. So to me, the risk is going forward that I think for most major institutions on a 5-year basis, at least, the risk is not being somewhat allocated to this space. And I don't mean the 20,000 highly speculative cryptos that you can find on CoinMarketCap. I mean the top 10, the top 100, an index that tracks those. So definitely Bitcoin, Ethereum, they could drop down, but to me, an index that tracks those is just going to continue doing what it's doing. And these type of things often carve that foundation. The key thing to remember right now is the Fed's still pounding hard. All risk assets are going down. Cryptos were the fastest one on the way up and the fastest one on the way down. And risk is so basic to mitigate. It's all about positions. So when you have a risk asset trade 62% volatility or 70% volatility about Bitcoin, you don't want to overload your portfolio though. You risk weight it, meaning if you have a portfolio that typically trades 10% volatility, you make sure that Bitcoin's a very small part of it, and then or cryptos, and it's all relative. So those who overweight have found out the hard way, and I really feel bad for those who've had investments that have gone up and they've gone poof. But when you come a futures background like I have, where leverage is normal and firms go out of business for silly, stupid stuff and greed like FTX did, just seen it before. It's just what do we do out of these ashes? And I suspect that's what we'll be getting to.
Whoa, that's already a couple of powerful statements right there, that I definitely want to develop upon as we go. Doug, I have a question, right? Because we already mentioned, we know that overalls of crypto are risky, right? But relatively this year, there's definitely been a little bit of a of this lag behind the tech stocks, just like Mike said. But what are your specific risk measures you would track, you would define, but basically about your portfolio to track?
Yeah. So look, I take a very, very boring approach when I have to do this for retail investors, right? So I have to look at how, their allocation to crypto or Bitcoin or, whatever digital asset, NFTs, whatever they're getting involved in relates to their overall portfolio. And Mike did a good job setting me up here because, what he said is what it's about. How do we make sure that exposure doesn't create so much overall volatility in the portfolio that you get an investor who can't handle it? And if they can't handle it, that's when behaviorally we start making really bad decisions with our money. And that's when we start blowing up financial plans. Can't happen. You can't allow that to happen. So you really do need to dial in terms of how much do you want that position in crypto to kind of wag the tail here, or how much you want it to really sway the overall performance of your portfolio. It usually lends itself to less than 10%, often 5% allocation. It's almost cliche to say that on a market portfolio, but at any time you see like a grayscale fact sheet or anyone in the retail oriented space of crypto, they're going to show you what 1 to 5% allocation on a market portfolio looks like on a back test, assuming you can. Bitcoin's the only one that can go back far enough to probably be a decent back test. And that's the way we still have to deal with it today. And I think those allocations are going to be locked a little tighter to those sleeves, right, in the overall market portfolio because of what we've seen. And it's interesting now to see clients who have had outsized exposure because, let's use Bitcoin. Bitcoin did so well, right? They had gotten in at 10, 15, 20, rode it up to 59. All of a sudden, that 5% stake became 20 or 30, or even 20 became 40 or 50. And what's interesting is how then you rearrange or deal with that, right? Did we take that off, the table and back down to what the original concentration should be? So these are just these are the mechanics that go on in conversations with clients who come to the table already being exposed, excuse me, to crypto. And I think one thing I want to say before, we kick it back to Mike here, it always amazes me how, crypto or Bitcoin is viewed as, anything really too different than any other asset in the portfolio, right? It's not any different in the fact that the rules of risk and reward still apply, right? Like I just think a lot of trouble takes place when you start to look at this differently than any other asset that you would configure as part of your portfolio, as part of your investment, program or philosophy. And when you start doing stuff like that, and you start breaking down relationships that should be ever present in investing, one way ticket to trouble, one way ticket to having results and outcomes that you're not going to be all that happy with.
One-way ticket it is. Mike, what about your risk measures? You mentioned, of course, annualized volatility in terms of, is it a standard deviation that you actually annualized returns that you track?
I'll touch on that. I just want to follow up on something that Doug said, and that is,
please do.
I fully expect that at some point in the near future, it might take 2 years, but certainly within 5 years, that we're going to have problems again. Those of us, I can't give investment, but people who are allocating to cryptos on this dip are going to have problems with that asset class being overweight in their portfolio. It's just a good problem to have. And I hope Doug has a lot of problems because it has a tendency to do what it should. I think it's going to do what it has been in history. It outperforms virtually every asset, most notably when things go up. But the world has changed a little bit, with the Fed tightening, the stock market maybe pushed to the wayside for now. So I think that's going to return. And these are times usually when you look back from the future and you say, okay, well, that was the time I should be allocating. Now, yes, I've been too early, but everybody's been too early. And that's why I like to point out so far this year, total crypto market caps may be down about 1.3 trillion. If you just look at Amazon and Google, they're down by 1.4 trillion. That's just two stocks. So that to me puts that in context. So what I like to watch for risk when people, it's a thing I've published a lot on the terminal because it's something that institutional investors really focus on. What's your relative risk? And that's typically a measure of annualized volatility. So one thing I published recently is if you look at the annualized volatility of of Bitcoin versus Amazon, it's 1-to-1, basically about 1-to-1. It's the lowest ever. And the key thing you look at is Amazon. And those of us who remember when it first went public, it's 25 years old. It's getting some major significant growing pains. Now, Bitcoin's really only been around for realistically less than 10 years. It's just getting started. And I look at it as supply going down, demand adoption going up, bump in the road, go back to that trend. What changes that? And that's just Bitcoin, right? And that's why I look at markets. So typically for risk, I use annual volatility. But recently, I wrote about, I focused on I'll focus anything that I see sticks out and that matters. And it was the key thing I noticed was our Bloomberg Galaxy Crypto Index, 30-day volatility, and that dropped to the lowest level ever versus the S&P 500. That was right before the breakdown. So that was a sign things are going to happen. I thought cryptos would outperform, but they haven't. It's gone the other way because they're leading on the way down. But that'll lead to the other thing. So typically that's what I watch for risk. It's when you add those exogenous risk factors that Doug pointed out that there's not much I can do about. That's more what I think the system is going to do, and that is going to really be what we're going to see out of this is pretty significant regulation. I hope the U.S. doesn't mess it up. I don't think they will, and it will really help institutions get into space because it also eventually maybe we'll be able to push a button and be able to buy an ETF that tracks an index, a broad-based index from physical cryptos. So you don't have to worry about picking winners. It can be like a classic long investor wants to get exposed in that space. And to me, that's a regulation that's coming. It's a matter of time. And that to me is what's going to come out of this. So the key thing I like to think about, and Doug, and I'm sure that's a lot too, is what are we going to be talking about a year from now? And that is where part of the risky part of the job is. And you have to risk being wrong, but I fully expect a year from now, the macro is going to be, we're in an enduring deflationary recession on a global basis. And the Fed's not easing like they have in the past. No central banks are easing like they have in the past because of the risk of inflation they've already saw. That's a lesson we're going to hear for the rest of the future. But they'll be forced to wimp out like Nouriel Roubini says. And I see some assets outperforming newest long bonds, gold, and at some point Bitcoin and Ethereum's in there too. It's just a question of when that starts. So that's my base case for what we're going to be talking about next year, which I think is going to help put that bottom in Bitcoin becoming more of a risk-off asset like gold and bonds, as people realize they're going to need alts because stocks are probably going to take years to get above that old high. It's just normal cycles. And what's your fastest horse in the race for the last 4 or 5 years? It's been cryptos.
This is very interesting. I find it very interesting because right before this show, I was having the show as well for this free trading congress with Macroeconomic, right, who specializes in macroeconomics and the overalls of the microfinance, if you will. And we were discussing, to what extent we can truly price in recessive environment, right? So I hope that this kind of again slowly translates us to the next point of the discussion, because hopefully this is where you gentlemen disagree, right? Because this is a debatable question then. But are we in a recession then?
I think we are.
We agree.
Yeah. Once again, I on this is gonna be crazy, but on vibes alone, on sentiment alone, I think we are. And I think this is a unique recession because of how much financial heroin was injected in the arms of Americans and the global economy at large over the last 2.5 years. And I think it's extremely difficult for those who are trying to understand, whether it's the Fed or economists or financial advisors like me. We hate the expression, this time it's different, but it is. Name me a time 7 trillion was injected in the economy and there was a global health crisis and supply chain got disrupted like this. Not just supply chain, but supply chain of this era, with what we have, an internet infueled, 2-day Amazon Prime delivery supply chain. Whipsawing, everyone got way too much money, and the mass consumption and the inflation as a result of it, pendulums swing both ways. And now we're swinging out the other way. And I think what people are trying to guess is, what's the velocity of that pendulum swinging? How quickly can it get back to the center? And does it get back to the center, or how much does it overshoot that? Because it's going to swing back the other way. And the optimist in me says we'll shake out a lot of things that truly were specifically related to this, hopefully once in a lifetime generation type event. Older millennials like me are experiencing their 9th once in a lifetime events, early on in their lives. It's a joke. We're numb to it at this point. But I think that's why it's so hard to dial in. And I think you're seeing that in economic indicators and data. Like there's just nothing saying that there it is, right? I'm getting mixed bags week in and week out. Strong consumer, strong jobs, but weakness over here. And then maybe it drifts a little bit, earning, and then you got companies, right? Then we go to earnings, right? Where's the compression there? You go to earnings, and companies, I feel like now are like, oh, we're going to have a terrible fourth quarter, retail specifically. We're going to have a terrible fourth quarter because, look at Target. We've sold everything, out of our inventory, but we slashed sales. So profits suck. And, we had decent revenue. So we're going to set the bar really low going into the holiday season when people are going to spend money. You know it. That hasn't stopped, that consumption. So what are they going to do? They're going to crush earnings, when they report Q1. And this is all just not really normal type stuff. This is also a product of, the drugs that were pumped in. And here we are, the Fed's hope. The Fed's hope is that they can wean us off the heroin, and have a functioning, person at the end of it. That's their gamble. That's their bet. And I think, to Mike's point, or Rubini's point, like, will they cop out? Will they, they're sticking to their word when it comes to raising rates. They were late to the party, but, they're giving you every reason not to fight them. I think they did what they told you they were going to do. They've done, and likely are going to continue to do that until we do see them or don't see them crap out. And that's a tough environment, and I just love it when folks are like, I know exactly no, you don't. You're guessing. You can be an informed guesser, but you got to be really critical these days, really, really critical when there's so many mixed bags of data, so many opinions, and so much noise out there too, right? It's the noisiest it's ever been. Finding calm waters is going to be a skill over the next 18 to 24 months as we deal with a recession.
Yeah, darn. Okay, so I'll only dispute one thing that Doug said is I don't think we're in the recession yet. But I do think we're in the midst of the biggest global macroeconomic reset of our lifetimes. And as a strategist, in my position, it's my duty to make sure I warn people when I see the hurricane coming. So I've been taking that up. And it starts with what Doug mentioned, all the biggest pump in liquidity ever that's dumping. That's the history of all booms and busts. I read the book recently by William Quinn and John Turner. And it was good to just refresh stuff that, I've known and traded forever. But I started getting these signals in 2018. And what that signal was initially was when the VIX Volatility Index, 50-week, 100-week moving average dropped to lowest ever. Last time I had that signal was 2007, just like Michael Burry. And it worked. We saw what happened afterwards. So this has been brewing for a while. And I think what I like to add to that is our Bloomberg Intelligence chief economist, Anna Wong, I'm going to meet with today in Washington, D.C. Her model says 100% for U.S. recession next 12 months. Same thing for Europe, pretty much in a recession already. And then you look at China, they're just trying to clamor up and they've been adding so much stimulus for almost 5-6 years, looking at these trends. Of property crisis is epic. Our team in Asia thinks there's another 25% to go. So to me, what saves us typically, it's aggressive Fed easing, fiscal stimulus, and we're doing the opposite. This is a 1929 type scenario, and by this time next year, that's why I think we're going to be discussing, man, unemployment's not so much high yet, but it's clearly trending higher. Everything's tilting downward, and it's so overdue. It's just like Doug mentioned, when we had the foundation for this is epic, and I hope to be able to teach it in classes and write the textbooks to tell the stories that we had the biggest, most significant event in our lifetimes with the plague, 100-year event, massive pump of liquidity. Now it's dumping, housing, just everything. So I love to when people say, oh, look at crude oil's up this much and costs are up this much. And if you overweight everything since the end of 2019 with money supply, which is up about 40%, anything that's not up 40% is a bear market. Guess what's not up 20%? The S&P 500 is one of them. The NASDAQ's one of them. Cryptos are still up more than that on a basis. So to me, this is the beginning. And I think Doug and I, unfortunately, I hope it's one of those things when you look at it, if I'm wrong, awesome, then we're all going to be better off. But I fully expect a year from now, that this is going to be about deflation. How do we get out of this? And it's the key things that you learn in some of the books I've read in history, like Jeff Booth, The Price of Tomorrow was one of them. Domino Effect, about crude oil, how we have more and more of it. There's just so many things that have led up to this. And now as strategists, it's our job. And it's also the key thing that I remember this in 2000 when we made that high in the stock market. It's a similar type of situation where everybody gets sucked into that. I guess it's the addiction of you got to be buying stocks and dips. And then it was something that really annoyed me that every time the stock market went down 20%, the Fed would ease. Just ruined my analysis. Now, the good news is we're going to transition back to the days for an elongated period where good news will be good news for the economy and stock market, and bad news will be bad news. It's still the opposite because the Fed's breaking that umbilical cord, and they know this is a historical opportunity to break that umbilical cord based on what happened with inflation. So I'm not come out of this, end up on a positive note. I think there is one major country that has the complete upper hand, and that's the United States.
What a way to put it into frames. I would actually love to take this opportunity, that Mike loves to argue in the constructive manner about like having different opinions. So let me put for you, gentlemen, a little bit of a challenge then that I think is going to also help a lot of viewers and listeners to perhaps comprehend better for our next point, because the next point is about building building portfolio, not necessarily crypto portfolio, for 2023, right? And let me play one or two charts for you in correspondence to what you mentioned. So on one thing, we're talking about VIX, right? About implied volatility index. Right now, it's like you mentioned, and it's definitely in its low areas. Right now, it's between 21 and 22. The market's just opened, and then when we scroll all the way up, what we are seeing and what we are looking at is that the industrial average, the Dow Jones, is actually breaking like towards very, very high levels, bouncing off the October lows very strongly. But for the first time this year, it's actually broken successfully over this long-term mean, 200-day mean, which basically represents this long-term trend, this bear market, right? So on one side, we are talking about, again, this recessive environment, kind of like, again, heading to implode the economy even more and even more deeply. But on the other hand, we are talking about Dow Jones, breaking definitely past couple of months records, in terms of the volatility, in terms of like it's pressing higher over, printing really something of a positive signal overall, because for the first time it's breaking over the 200-day trend of the bear market. So what do we make out of that? Like, how should we build the portfolio for 2023?
I'm up. So what I've been sharing with clients, right, is I do this day in and day out, is as I make my way through all the households. I'm very matter of fact about primarily what their biggest risk is. And I know it's going to take us away from the markets for 1 second. Their biggest risk for the demographic that I serve, which is mostly your late 20 somethings to mid 40 somethings, right? So these are either folks beginning their careers or in the mature part or maturing into their peak earning years. Their biggest risk is unemployment risk, right? They can handle volatility, especially with long-term assets or retirement assets. That's understood that they're going to have to go through volatility. We would hope it's not, stuff like, 08, 09, or even, this year. But we know that's part of the game, specifically because we're also mostly passive investors, and that's what's going to happen. So an honest conversation around what that real risk is, which is when the income faucet turns off, you eat cash, you eat assets, you take on debt in that order to survive, to live. If you can mitigate that risk, and there's only so many things you can do to control that, right? There's some really good ones: cash reserves, financial planning, physical, mental health, right? And then career type stuff, where you definitely don't want to be in the bottom quartile or bottom half of employees right now if it's a performance-based kind of thing. Time to step up. Don't give a manager or a VP a reason to cut you, regardless of being employed by a growth company or a Fortune 50 company. If you can manage that as best as you can, and you assume, in this case, something good, which is you don't get fired or laid off, however deep or bad this recession is, you get to take advantage of the opportunities that have presented themselves and probably will continue to present themselves and avail themselves. So great entry points right now for long-term investors, likely more pressure to the downside. If we just talk averages, just talk about average recession. Everyone in their own bias, this is recency bias or anchoring bias, uses 0809. Terrible benchmark to be using to give yourself a realistic expectation of what this could look like from a recession standpoint, right? So that's on average 33% drawdown if you're looking at the S&P, on average a 2-year period of time when it comes to how long you can expect a recession to be. You can keep doing this over and over to set some realistic goals. Now, the guesswork is, is this going to be a above or below average recession? That's where your guess is as good as mine. But at least we've established a decent benchmark. All right, with all of that aside, what we do is we see how prepared and how aggressive can we be when the times are at their worst, when you are the most nervous. How much control can we put in place? How much confidence can we build to go get discounted assets, right? Because one thing's for sure, if you're going to be a passive and even an active investor, if you're going to be an investor, even more so a passive investor, you have to be just as good buying on the way down as you are on the way up. Because if you don't, that's how the game you're playing is compound your returns. And you're not going to be able to effectively do that as much if you can't get really good, if not better, when things get wild and things are discounted, right? Then when you see something like the last 2 years, right? Like investing offering you immediate gratification, like it did over the last years, it's probably the worst thing that could happen. Especially for new investors, sets very unrealistic expectations of how the game is played. So that's my macro down into how it relates to the individual client or retail investor out here take. You gotta get as much control and distance. This is your test. This is your behavioral test as an investor, whether it's crypto or traditional assets in the capital markets, in order to execute and fulfill whatever your financial goals are, because it requires you to exercise and show that discipline to get those cheaper assets and therefore compound your money.
What a way to put it. Mike, what's your stance on that?
Based on what I mentioned earlier, I think this is going to be one of the worst recessions of our lifetimes. The foundation is significant for it. And just by the fact you see what's happening with the Federal Reserve and central banks now, the quote from Chairman Powell is need to have some pain. Normally, when you see things turning over like housing and stuff that we're seeing, the curve potentially getting the most inverted ever, the Fed would be easy. They're not even closer. There's still the forward curve, still priced for tightening. So to me, that's the 1929 type scenario. Just remember, also, I'll point out that the stock market and Dow dropped 50% in 1929, rallied 50% to the peak in 1930. The rest is history. I'm afraid we're going to have similar. And as Doug knows, bear markets rip your face off, take money from everybody, and I don't think we're even near over this. And I like to point out what happened this year as part of that foundation. I was way too early. I was wrong initially, but as Doug learned, sometimes you get stopped out of your position and you move on. But what does it mean? What really baited the Fed and every central bank on the planet, with the exception of two, China and notably Japan, from accelerating their rate hikes, was this big spike in commodities, and most notably crude oil. Commodities are notable for, as Doug mentioned, I love that analogy. I use it all the time, the swinging pendulum. They are the worst in the world to be long and buy, unless you're buying the producers, the ones who actually make the money. But when they make money, they sell more commodities. So this bait and switch is switching back to the switch part, where commodities are plunging. Crude oil on the year right now is up about 70%. Now it's, as we speak, up about 3%. I fully expect it to be dropped another 20% next year, and there's good guidance from that. Copper is down 20%. Lumber was up like 300% since the end of 2019. Now it's down. It's at the same level. Everything's tilting backwards. And to me, the key question I like to ask myself, ask you and Doug and Adrian, what stops this? Typically, the number one factor for the last 40 years has been the Fed and central bank liquidity. Poof, that's gone. Okay, we'll write that off. So what's next? The number one thing that usually stops this is an organic lower plateau, which I think is better for everybody, and that means we're far from it in equities. We probably have already reached that bottom in bond prices. Our chief income interest rate strategist in BI, Ira Jersey, has been spot on this year, thinks bond yields have peaked. I'm with him on that. So that's one thing I love in my spot here, is I can talk to my other Bloomberg intelligence people, see what's your view. And we're so aligned now. I talked to our chief economist for global yesterday, Tom Orrick. He's in our office, and his quote for U.S. global economy is from bad to worse. Risks are tilted that way. What saves us? Central bank easing. That's not happening. That's the difference. That's why I say you sell rallies in equities, you look to buy dips in bonds and gold, and hunker down, and cash is okay, because that whole history, we're going to look back at there's no alternative. There's an alternative. It's better than losing money.
This is that's quite a choice to make actually there about the alternatives to losing money. I wanted to ask you what I was processing with you, what the gentlemen were discussing. In terms of, again, building the portfolio for 2023, right? On one hand, we are having, again, those strong signals on the technical side, on the Dow Jones, right? It's breaking for the first time. Then BI specialists on the bond prices are saying that the bond prices have bottomed, right? I'm tracking personally the 30-year bond prices on the USB side of the tracker, right? We are looking at, like, also look at the TNX, which is the 10-year yield index, which kind of, like, again, is somewhere close to 38 right now per the units, which translates a little bit to, again, what traders expect to be potentially about the target fund rate. So knowing that there's still probably a lot more of a rate hike and more tightening coming along the way, how does it translate, again, altogether for building the portfolio in 2023? Like, on one side, stocks rallying, inverted yield curve is still there, right? It's still not gone. So how does it all translate and connect for the average investor there?
I'm really thrilled that I heard Mike talk a little bit about rates and fixed income here. Here we are agreeing again. I think
You
could just pretend for a second.
Just have one of us on next time, and we're no. Still waiting on that disagreeing spat here. But I think a lot of attention should be placed on fixed income. I think you really want to understand a lot about the economy. Go take a look at that market. It's obviously a much bigger space than equities. And the health of the economy is pretty much going to be viewed from the fixed income standpoint. And that's where are we? This is worst bond market in a century. How often do you get to say something like that? 100 years? Yeah, you get to say it once. And here we are, with our 10th once in a lifetime event, taking place, and 25% down on long maturity, long duration fixed. I mean, we can probably find more brutally, hurt, but anywhere from 20 to 25% down. You got to ask yourself, does that pain continue? And Mike, correct me if I'm wrong. You said probably bottoming out there on the price side for bonds, and that for someone like me is what and for older or your more older clients with more significant exposure to bonds. You take my average client, there's at most 20% to fixed income. But what we did is we took the Fed at their word. Look, passive shop, rarely making a call. But the place I do make calls is around fixed income, because you have older clients who have a lot of exposure to it, and you have younger clients where you might be able to actually, save them a few basis points in performance. And the call I made was, I'm going to take the Fed at their word. They're raising rates. They're not going to not do this. And if that's what they're going to do, I would expect bond prices to get crushed. If you got duration in your portfolio, time to get that out. Like, you want to be zero, if not hedged, out of that. And from February to May, the amount of time it takes for a practice like mine, to actually, shift everybody, from being long duration to virtually no duration. And that was huge. I mean, we created a 10 to 7, a 7 to 11 point spread in performance, depending on when that happened, in a core bond, in your core bond position. But here's the trouble with that, right? You have to figure out when to go back long duration. So great call, on the way out of duration, when you get back in. So we're going to pay a lot of attention to trying to get that right. And I think that looks like, what right looks like is probably being early rather than late on that trade. And I think now is where you can be early, right? So we're going to start to have that, whether it's 50% to 100% back on, with duration in our bond portfolio, in our bond section of the portfolio. I think that's going to take a lot of attention, a lot of my attention into the conversations I'm having with clients, because on the equity side, I expect more pressure to the downside. I do. I would happily be wrong and trade down 20 to 25% for an extended period of time, multi-year period. Cool. Let's scoop up 20, 25% discounts on the S&P 500 for a year and a half, 2 years. Fantastic. I don't want to scoop up 45% discounts a la 08. But if your average drawdown's 33%, we got more discounts to scoop. And if we're talking about young clients, we got to go get them. And the way we're going to go get them is being confident, back to my previous conversation. So again, my eyes are on how do we keep money coming in the door, prepare ourselves for that, disruption taking place, but also be able to go scoop up, I think prolonged, relatively speaking, multi 1 to 2 year period, hopefully, of those depressed equity prices, and start to see the fixed income side. It'll be, I guess, to be very specific, how will these next rounds of 50 basis point hikes affect the 10-year and longer dated, part of the curve? Is a lot of what we're seeing here with the 10-year pretty much where we're at? Is that baked in, so to speak? It will be a utter disaster to watch, fixed income fall another, speaking broadly here, Barclays aggregate fall another 10%. Yikes.
That would be rough. Would you like to comment on that, Mike?
Yeah, just a few key points. We have this probability model in the terminal. When you look at 2's 10s, it's worse than it was in the last time for a recession, just like it was for at the start of 2000. 2's 10s are the steepest right now since most inverted since 82. It's going to be hard to get to all-time high, but it's clearly going that way, because we know the key thing that struck me now is Doug does too, is try to say, okay, what are we going to be talking about 12 months from now? And taking that risk of just saying, this is what I think is going to happen. The key fact I like to point out is we are still saying, don't fight the Fed. And 12 months ago, that was my key mantra, don't fight the Fed. It was just different from the past that, they're not helping you. They're hurting you, and they need you to have pain, or inflation's not going down. And to me, this is going down in history, one of the biggest baits and switches in history. They created too much liquidity, and then they took it away as the energy market made it look like inflation's worse than expected, and now energy and commodities are just collapsing. And guess what? That's normal. So I look at it is, it's going to be, as far as when and where to get overweight long equities, which I just like to use that example. It's probably better be underweight long equities, and overweight long duration, which I've been wrong. The key thing is, when you buy long bonds, you always get the premium. U.S. Treasury long bonds, they don't, it's like buying zeros. They always go to if you buy a 20-year zero at discount, it always ends up at 100, unless the U.S. government defaults, which is not going to happen. So that's one difference there. And I think the key thing to watch is I look at the sore thumb that I see happening so far is every asset's gone down a record amount this year, and it's been really tame for equities. I mean, we have that VIX at 21%. I mean, that's nothing. Typically, it gets to 50 before things, or 40 before things get out of hand. So that's an orderly sell-off. But the key thing that's still a sore thumb is commodities. Commodities are still up about 10% on the year, measured by the Bloomberg commodity index, spot index, and they need to go down a lot, or the Fed's going to keep tightening. And that's one of the key things I look for. What are these iterations the Fed's going to say, wake up one morning and say, oh, we don't have to tighten anymore? Pretty big collapse in the stock market, like a stock market crash, or you wake up and you see WTI crude oil down like 20%. I mean, not one day, but that's what it's going to take, where you can see those leading indicators are pointing towards massive deflation. And I look at it as, I don't give investment advice, but that's why my team launched a Bloomberg Galaxy Crypto Index in 2018. Is trying to allocate to cryptos is difficult, but if you can, at some point when you can buy an index, I'm sure Doug has better ideas on how to do that. Just figure out your percentage and figure out your weight, and just look to be buying dips of that index. And that's some way to get exposure. That's the way I look at going forward. But again, the key theme right now is don't fight the Fed. So if you're bullish equities, you're fighting the Fed.
Don't fight the Fed. Yeah. Doug?
Yeah. So it wouldn't be me. I love all of this, and it wouldn't be me if I didn't put a giant asterisk on a lot of what I've said, and the asterisk there because I think investors need to hear this consistently, and it's that this is not easy. We come into these conversations with professionals with credentials and thousands of hours of academic rigor and multiple decades of actual experience in handling people's money or making calls or putting our thoughts out there for the public to scrutinize, and we get it wrong and we get it right. And it doesn't become long before it gets sucked into the noise that is everywhere. And it's unfortunate because I think a lot of really great ideas and thoughts do get sucked into the vacuum of whatever, channel you're partaking in, whether it's Twitter or anything, or LinkedIn. I was doing that on LinkedIn. And that this isn't easy, right? And I mean that for my clients, right? For the retail investor who has to make that purchase on the 15th or the 1st of every month to QQQ, IVV, S&P 500, NASDAQ, mid caps, small caps, their bond position, and literally do that consistently, regardless of what's going on in their lives, in the markets, in the economy. Just to do that, just to get that right. It's the most boring trade in the world, allocating to a market portfolio consistently. It's hard. It is super hard. Please, please, please don't listen to your do-it-yourselfer friend who says it's easy. Most people don't. Yeah, and God bless the do-it-yourselfers out there who get it right and have the discipline and put themselves in that position. They're the exception. They're the exception. I wish what was normal was people like, yeah, I get it. Let's control our cash flow. Let's find what we can consistently save and invest each month, and then deploy that capital into my favorite index funds from now until 55, when my plan says I can have financial independence. I can make it sound as easy as pie. It is so hard. That in itself is hard. And for every time you get out of that construct, like, okay, I have to trade. Okay, what's a 200-day moving average? What's duration doing? Will I keep my job? Oh, wait, that has nothing to do with the economy. It has everything to it exponentially gets harder. And I want people to realize that when you're investing for your own future or financial goals, please, please have some grace. Give yourself a little bit of space here to understand that what you're asking yourself to do, especially if you haven't gotten the practice in doing it, right? It's reps. It takes reps. Do this 5 years in a row. So, 2 years in a row is a good start. 5 years shows me you got it. 10, you're platinum status and you're on your way. And guess what? Life is going to throw every wrench and curveball at you during this entire time. So can you stay on the balance beam? Shit's hard. Very, very hard. So just remember that when you're putting in your boring trade to the S&P 500 because things look good as far as entry points go, or you're saying to yourself, yeah, recessions only come around every 7 to 10 years. This one was 13. Bear markets every 4. Other than the blip in 2020, I don't think we've seen one in a long time. It's almost like you can't afford to miss. For me, this is my second recession as a full-fledged adult. I'm 38, despite popular belief. I can tell you I was too young. I'll speak for myself. I was too young and broke to take advantage of anything in 08 and 09. So if you're in a position, you can't afford not to. And I acknowledge that there is that level of pressure out there, but there's also some acceptance that you should have around how difficult this is. And please know that, to tune out your fire friend, tune out your other friend that's trading crypto, and realize that's just a whole other level of complexity that they're attempting to do, versus the already difficult task of just being a really good, disciplined long-term investor.
That to me sounds like a perfect takeaway, actually, and an actual golden tip for tons of viewers and listeners who are going to listen to this Free Trading Congress Day 3 show with Mike McGlone and Doug Bonport on the spot here. So having already the takeaways printed and really put forward, on the Doug side, what would be your golden takeaway and the final tip to leave the viewers and to listeners with, Mike, heading into 2023?
Ignore the dailies, watch the weeklies. When you mention 200 days, my lesson I've learned is I made a good living trading on a weekly basis. So you're going to have some traders with good algorithms and quant models and things that might do well on a daily basis. Focus on the weekly. So I usually, like I pointed out today, the crude oil is breaking down below its 100-week moving average. It's going to go to 200-week moving average. What stops that? Algorithms are signed up. But to me, that's the key thing, is the day trade will make you lose your hair. Been there, done that, seen it. And that's the key thing you learn in the trading pits is the easier it is to trade in and out, it's just going to rip your face off eventually. And if it doesn't, maybe 1 out of 100, 1 out of 50 do well at it consistently. It's knowing when to get out. And there's so many algos out there now. Just good luck. I'd say focus on the bigger picture, positioning. How you define trading is up to you. Focus on the weeklies. And the key thing I want to point out that really struck me, and that a couple of years ago that I've been pointing out easier, is one thing I enjoy about Bloomberg Intelligence, I can write what I want based on my views. And I don't have that, as Doug has seen before, I don't have that push from being on the sell side or having positions on the buy side. And that's the key thing I like to point out, is the difference between things like Bitcoin and Ethereum and commodities. There is a definable, limited supply of these two top cryptos. And there's definable increasing demand and adoption. Something has to change in that trajectory of both, or price must go up over time. And we have pretty significant discounts at the moment. It's the exact opposite in commodities. I love pointing out the price on the screen on WTI crude oil right now, the world's most significant commodity, is the same as it was first traded in 2007. Cryptos didn't even exist. I can see definable diminishing demand and adoption and definable increasing supply. North America used to be the biggest consumer, now is a net exporter. That's just the way things work in commodities. But that's why I find revolutionary about this technology. And then I look at things like Ethereum. What's it doing for making the most widely traded cryptos on the planet happen? That's crypto dollars. I mean, I just look at this and I'm like, yeah, it's getting beat up, but yeah, McGlone looks like an idiot in the short term, but give me a couple of years, and just having been in the trading pits and seen those go poof, gone. Been in a voice broker and seen that business go poof, gone. It just, so much of this is you can't take the risk of not being part of this technology. And what struck me the other day was, why are we talking so much about cryptos when they're less than $1 trillion versus, Doug pointed out, the bond market's like, what, 10 times or 5 times the size of the stock market. And that, that's about 100 trillion. It was about 120 trillion earlier in the year. Why are we talking so much about this? And why do you, when you fill up your taxes, you have to write in there if you're in the US, if you're involved in cryptos? Because it's that significant. I think everybody gets it, that this technology is here to stay. It's revolutionary, and you got to be part of it. And that's been from someone who was called McGloom in 2018 when I pointed out Bitcoin is probably going to go to much lower than 10,000, and I thought it was going to get to 900, and it didn't. And now I'm bullish, just not in the short term. So, but the big picture is got to put yourself. You got to give yourself allocation and time. And trading is difficult. I mean, and that's from someone who's seen it, been there, done that in the trading pits. These guys would be 1-2. You buy one, you sell it 2. You buy it's bid and offer, and they would trade. They're the quintessential day traders, and their leverage was typically 20 to 1. So that's why this space. Yeah, I mean, here's an example of leverage. People say don't use leverage. Well, did you buy a house? Did you put 20% down or 10% down? 20% down means it's 5-to-1 leverage. It's just, that's life. That's, we're not living that world of Mr. Potter from It's a Wonderful Life. We're living in this real world. Just be careful with stops, discipline yourself if you're a trader, and focus more on positioning. I think that's a better. What Doug suggests.
What a great way. What a great way to finish off the show. Ladies and gentlemen, I really wish we had more time on the spot here, but having already so much generosity and wealth of knowledge coming and experience coming from Doug and Mike McGlone, I'm here to start wrapping up the show. Before we go, ladies and gentlemen, please rush over and flat in to the Twitter accounts of these two great legendary gentlemen, analysts, proficient traders, investors, and strategists to talk about the markets. And you're going to find them at Mike McGlone 11, as well as Doug Bonepart, just like it reads on the screen right now. And before we go, please remember we all have the shows going on and running along with our free premium membership for limited time for everybody who wants to come and learn about technical analysis, about the markets, about investors, about investing, and the best practices to actually, again, prepare for 2023, especially that there is not so much of a soft landing on the horizon. This is all free of any charge whatsoever. Let it be heard. And with the help of great regents just like Mike McGlone and Doug Bonepart, it's getting even better day by day. So having everybody again reminded, make sure to check the video description if you're watching that on YouTube. We have a giveaway going on where you can win free prizes, this case free premium membership again. That is worth a lot of money for everybody. If you don't really wish to pay but you want to stand the chance to win, feel free to head over to our YouTube description for this video and you're going to find the giveaway link, and a special giveaway link is coming with a secret code, Free Trading Congress. That's the secret code that you have to only put in there in order to apply and stand the chance to win. Ladies and gentlemen, this has been Adrian Zdunczyk, Cryptoberg, talking to Mike McGlone and Doug Bonepart on Congress, Free Trading Congress Day 3. Thank you, gentlemen, for coming over.
Thank you.
Thanks, man.
All the best, love, and see you on the next one.
Cheers.